And hello, everyone. John Hutchinson with Traders Reserve and the Earnings Player. Welcome to our webinar this evening. I realize it's just after the 8 o'clock hour, or just at the 8 o'clock hour here, and many of you are still getting into the room. You may have, it may take about 30 or 40 seconds for the audio here to catch up to you, so just be patient, and it will do so. And we'll be getting underway here as soon as the room is full. And I do a couple of quick housekeeping items. So do expect a pretty good crowd tonight, so I want to make sure that leave a little bit of time here at the start to make sure that folks get in here. So we'll get started within the next 2 minutes. As you are getting your screen set up, making sure your volume is okay, I do want to do a quick audio and video check. And to do that, if you would, just type a yes or a Y in the chat box to the right of your screen and let me know that you can hear my audio okay and see the title slide of our presentation for tonight. Just, again, a yes or a Y, and let us know where you're from. It's always nice to know how far around the world we are reaching with our webinars. So we'll take about 30 seconds here for all of that to catch up and for all of you to be able to type your answers in with that lovely audio delay. But then we'll be getting underway and be able to move right along. The running time tonight should be about 35 to 40 minutes. We will be recording tonight's session. You will get a replay email of the recording once we're finished. And we'll also be sticking around to do questions and answers, so feel free to ask as many questions as you would like. I realize it's Football Thursday, so for those of you who have fantasy football teams, like me, we'll try to get you out well enough in time to catch the majority of the game. So we have a lot to talk about tonight. I know there's probably a fair amount of nervousness with what's taken place in the markets this week. That's to be expected. That's normal. And we may talk about some of those things because we're heading into what we believe, myself and the expert that I'm going to introduce you to in just a little bit, what we believe is probably one of the most critical earnings seasons for U.S. companies this year. As you all know, back at the beginning of the year, we had the winter doldrums, and so there was not very much, there were pretty low expectations for companies coming out of the first quarter, and then in the second quarter, those expectations were marginally raised, and of course, all the companies did very, very well because they were all, so to speak. The last quarter, however, this past quarter, really could be a bellwether for the rest of the year in the stock market, in part because we expect that many of the companies are actually going to surprise to the positive side despite the market being in a corrective phase right now. So we'll get to all of that as we get going, and welcome to Jeff and Joanne, Walter, St. Louis. Congratulations to your Cardinals, sir. Tom, Los Angeles. Sorry about your Dodgers, sir. We've got Robert from San Diego, Howard, Lakeland, Florida for Bobby, Boston, Massachusetts. Brad from Northeast Ohio. It's a lovely area of town. Love Toledo. Big fan of a hot dog restaurant there. I can never remember the name of it, though. Let's see, we've got a bunch of folks from Ohio. Great, good to see all of you folks here. Okay, so let's get going. To start with a little bit of housekeeping from the Keep the Lawyers Happy side. So before we begin, just a quick disclaimer. Forex, future stock, and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being using the earnings player methodology or system or the information in this presentation will generate profits or ensure freedom from losses. We're sorry about that, but that's the fact. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades may or may not have been executed, the results may under or overcompensate for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Isn't that awesome? I mean, you're here to learn how to make money, and we have to tell you you're not going to. Isn't that great? All right, well, if you're a fan of watching paint dry, grass grow, or water boil, you're welcome to read our entire disclaimer at tradersreserve.com. But enough of the legal stuff. The lawyers are now happy. We are free to move on. If you are an investor or trader who needs fast growth of a small account, wants immediate gains of 100 to 500% or more, and enjoys using options for what we like to call big gain hunting, then we want you to get ready to sweep up the profits this quarter during the earnings season. As I sort of alluded to in our my little preamble, we think that there's a great amount of opportunity in earnings season. We'll talk about why. We'll talk about how you can find that opportunity, and then we'll show you and teach you how you can take advantage of that opportunity. Now, as we get going on, and a couple of Tony Pacos, thank you, Brad. Thank you very much. That was the hot dog place. And Michelle from Montreal, welcome to you as well, sir. By the way, folks, a quick program note. If for any reason your screen freezes during the presentation, please simply log out and log back in. Sometimes that happens on Wi-Fi systems as the data stream gets interrupted. So as we were talking here, let's get ready to sweep up the profits. More specifically, we're going to talk tonight about how you can exploit Wall Street's earnings game for 100 to 500% profits. We will show you examples of those profits, and we will describe and explain to you what that game is. We're going to teach you how you can double or triple your money with simple options trades, and we're going to teach you 5 quick keys you can use to find these fast-moving trades. And the best part is you're going to learn how you can use this strategy in 30 minutes or less. It's that simple, and we keep it that way because we like to keep it simple. Simple is better. Also in this webinar, as we told you in our email, we're also going to share with you 3 trends that you can use to profit from during earnings season. We're going to specifically look at 3 companies that you can trade, and we're going to walk through each of those trades as we go through the presentation tonight. So you're actually going to walk away with 3 trades that you could make on your own using the process we're going to teach you tonight. We will review the five quick keys that we're going to teach you on each of those companies, and then we'll give you the exact trading strategy to use with the 3 companies. So again, when you walk out of this webinar, and we will be giving you an invitation to join our Earnings Player program at the end, so I want to make sure you know that's coming. No great surprise there, but it is coming. But even if you don't join our program, we want you to walk away with 3 high probability trades tonight and a simple strategy that you can use to profit from those 3 trades. So that's our promise to you, and that's what we will keep as we go through the presentation tonight. Now, here are some examples of trades that we have made in our program over the last few quarters using the strategy that we're going to be sharing with you tonight. And I just want you to get a flavor for the potential. We had a put option on Intel after they missed earnings expectations that gained 157%. A company called Weatherford International, which beat its earnings estimates, resulted in a call option that gained 200%. Coach, the luxury retailer, they missed their estimates by the fabled country mile, and a put option on Coach when the stock dropped 15% actually exploded for more than 300%. And our best trade so far year to date back in May of this year was America Online, AOL. When they badly missed their estimates, our put option went up 525%, even though the S&P was rallying the same week. So it was all good stuff for us, and what we are going to be teaching you is exactly how you can take advantage of trades like these. And with me tonight is my earnings expert. His name is Jamie Delugus. If you do know Jamie, you know this introduction. If you don't know Jamie, briefly, he is a 25-year veteran of the stock markets and an investment professional. Halbert Financial Digest previously ranked his Rational Investor a #1 newsletter. He currently writes for websites including Traders Reserve, MSN Money, MarketWatch, TheStreet.com, and others. And he is an investment analyst and expert behind the Earnings Player, which we will describe to you later, and the program he works with me on, the Millionaire Blueprint. So, Jamie, I want to thank you for joining me tonight. I know I'm sure the girls probably had their soccer game, so hopefully they did well. And welcome, and let's get moving.
Well, thank you for having me, John. You're absolutely right about that. We did have soccer tonight. So I got that out of the way, and I apologize in advance if you hear them in the background, because I do have them at home tonight. But I wanted to make sure I got on this presentation because it's a really exciting time. You know, John mentioned it, you know, a lot of people might be fretting over what's going on in the market, and if you're not familiar with the earnings player and trading earnings like we do here, you might not quite understand this. But if you have been with us before, then you recognize that I'm drooling right now. I mean, the volatility sets up so well for not just triple-digit winners, but I'm talking about the massive AOL-type 500% winners. I think we're going to have multiple 3, 4, 500% winners this quarter, John.
Well, I know how much you enjoy earnings season, and maybe it's a good time, given given the fact that the markets, the indexes, have had really a huge struggle this year in generating any traction. Why is earnings players should be considering as part of their trading portfolio?
Well, the program that we set up here. It might be a little counterintuitive, but it's a low capital-intensive program, so you don't have to risk a lot of capital to play the earnings player game. And because we're using very simple call and put options and the leverage that comes with it, we have the ability to, over the 6 weeks, 25 to 30 trades, add anywhere between $1,000 to $5,000 of extra cash to your portfolio on an average trade of only $500. So anybody can play this game, no matter what your net worth or what your portfolio size is. And because earnings are reported each and every quarter, it's repeatable. So with the things we're going to teach you tonight, you can do this each and every quarter because companies have to report earnings.
And one of the things that we teach and preach, if you will, is you don't have to go sort of all in on every company reporting earnings. You can narrow things down to just a few companies and use what we call the precisely timed put and call options to get those potential gains.
That's right. As we're going to show you later, I use 5 specific keys. I'm analyzing every single company that reports earnings that has a weekly option that's available on the CBOE. And through that analysis, I identify my favorite 5 or my most favorite 5 trades that we can place each and every week using those weekly options.
Well, you mentioned the 5 quick keys, so let's walk through those if you would and teach everyone what those 5 keys are and how they can use them.
Right. It's very, very simple. It's about, number 1, looking at the current sector, the sector of a stock, and the trends in that sector. Are there any unusual or overlooked trends in the markets? So today is a great example of that, John, because you had a market that was completely washed out, red all over the place. In a market like that, specific trends to industries that might be doing well become completely ignored. So this morning, for example, United Airlines lifted their guidance. That was a very positive development. And in an industry now that what's good for one operating company is most likely good for all operating companies, United Airlines stock was up today. The other airlines actually were down and down hard, irrespective of the good news from United Airlines. So you can identify these current trends and trade on them. Number 2 is valuation. It's the beautiful thing about earnings is that speculation takes a back seat. And if you get nauseated by the speculation and the high frequency traders that are manipulating the market, then earnings trading is for you. When a company reports earnings, you have to keep in mind that a stock entitles you to a portion of the future cash flows of that company. And the way a stock gets valued is by discounting those future cash flows to the present. What are the future cash flows? Well, those future cash flows are earnings. And so throughout the quarter, the market is simply guessing how a company is operating. And when earnings are reported, it is at one moment in time that, like I said, speculation goes to the wayside and valuation comes to the fore. So by identifying over or undervalued companies gives you an idea of what companies you can trade during earnings. Then we look at number 3, the earnings expectations. What are the trends on how this company has performed against Wall Street expectations? We look at past performance, and that can be often indicative of the future. Speaking of the future, number 4 is looking at those future expectations. Are the Wall Street estimates for a company rising or falling? this one piece of information alone can help you find some of the best trading opportunities. Because a lot of times companies will tip their hat to the analysts. They're not really supposed to, but the way information moves, it's impossible to police whether or not a company is disclosing early what's going to happen with respect. I mean, when a company misses by the proverbial penny or beats by the proverbial penny or hits the number exactly, how do you think that happens? It happens because the company tips off the analyst, okay? So you can identify that by looking at the future expectations. And then number 5, the last thing we do is incorporate a qualitative measure by looking at market sentiment. So right now the market sentiment is really, really poor, and identifying companies that we think are going to do well, those can become your 400 or 500% winners during earnings season.
All right. Well, let's take a deep dive into or at least a semi-deep dive, maybe a 3-foot dive into those 3 trends and the 3 companies, the 3 trades that we want to share with people tonight. And to get started, you mentioned United Airlines as sort of giving away perhaps the secret that one of these sectors is going to do very well. But you talk a little bit about what you're looking for, what you found when you were looking through what's coming down the pike for earnings season this next quarter.
Well, like I said, there are certain trends that are emerging that I am very confident will produce 300 to 500% winners. The best thing that can happen in advance of earnings season is uncertainty in the market, and we're having loads of that. So we're going to get a lot of companies reported. You know, today was actually a good day in the market with respect to earnings. Alcoa reported strong earnings today. PepsiCo reported strong earnings. And so you're seeing a washout in the overall market. But if you know, using the 5 keys that I've showed you here, if you can identify the companies, again, this isn't a crystal ball, but if the preponderance of evidence suggests that there's going to be an earnings beat, that creates a trading opportunity. So instead of guessing when the market's going to go up 500 points one day, down 500 points the next day, I think, and again, this might be counterintuitive because everybody says you can't trade earnings. Well, I'm here to tell you that you absolutely can.
Well, let's dive into that first sector, and we've pretty much already given it away, but we've been playing the airlines for several quarters now.
We sure have, and boy, you know, not only is this my favorite trading opportunity during earnings season, but it's got to be probably right now my favorite long idea that you can find. And it's very simple. You have a market that is constrained by low capacity, and competition because of the consolidation in the industry is diminished down to basically nothing. So at the same time, airline stocks are getting sold off hard. Across the board, they're in bear market territory, down from their highs, down more than 20%. If you look at valuation, earnings growth expectations, and the multiples that these stocks trade for, you recognize that there's a wonderful trading opportunity. The trigger for that trade is going to be earnings. As long as the earnings are positive and there's zero indication that it's going to be negative, we saw today already with United Airlines that they raised their guidance. You're going to get you're going to have a lot of money-making opportunities in the airline stock this quarter.
And a corollary to that, folks, too, is if you want to get an idea of what we're talking about, for those of you who like to look at charts, for example, if you took a look at United Airlines back in April of this year, when they reported their earnings and they missed rather badly, the stock fell off the shelf by about 15%. So oddly, now they're raising their guidance, and there are a number of reasons that Jamie has sort of alluded to here as to why. I think, Jamie, one of the biggest points that you had, I think we'll talk about this again in a little bit, but is the fact that oil prices have collapsed.
I think that's not nearly getting enough play in the financial press or the financial media.
Well, we'll keep that our secret then, and let's move on to the chaos in the retail space. This has been a trend that you've been watching for a couple of months now.
Yeah, that's right. And valuation disruptions here are substantial. Especially in apparel retailers where the consumer tends to be a little more fickle. It makes it very difficult for the market to get pricing correct. And again, if you think about it this way, that when earnings are released, that's the moment in time the market has to correct its mistake. And so a week or two ago, Nike released earnings that absolutely crushed expectations. Their size and dominance in the market allows them to expand their profit margins. And after their earnings report, the stock went up 12%, which tells you the market had it absolutely wrong before the earnings report. So there are a lot of opportunities in apparel, and not just apparel, but retail in general, where today, the Gap, for example, gapped lower because its CEO was resigning. It's just, there's so much nonsense going on. And what I really love about earnings is you're dealing with facts. I have a daughter. I was working with her this afternoon on her math. Math is absolute. Numbers are absolute. Markets are full of emotion and irrationality and speculation. And so if you like numbers, then you're going to like earnings and trading earnings.
All right, and then our last sector is the housing market, which has come under pressure yet again this year.
It's been a couple years of fantastic news in the housing industry. Some of you who've been with the Millionaire Blueprint know that I was very optimistic about the housing market heading into the spring selling season. The winter I knew was horrendous, and I thought the market had these stocks mispriced. The reality was the activity and the building activity, the home selling activity, the pricing power of selling homes all changed this summer, and I think it's just going to get worse because of the headwinds that the markets are facing with rising interest rates. So typically, home builders, you're going to want to buy those when they trade below book value, and right now they're trading for anywhere between 1.5 to 2 times book value. I'm not seeing strong numbers that can be delivered with an earnings report that will sustain these higher valuations. And we saw recently KB Home report results that missed expectations and the stock sank. You've got mixed third quarter economic data, and the data doesn't suggest strong housing market at all. So the risk here is to the downside for sure.
All right, well, let's keep moving along and get into the actual 3 stocks, and we'll walk through some of the 5 keys on each of the stocks, so that you can understand, so that you, the viewers, can understand the rationale behind the trades that we're going to suggest to you here. And starting with the airline industry, our first stock up is American Airlines, Jamie.
Yeah, and American Airlines is one of my favorite stocks. From a valuation perspective, it's just an absolute no-brainer. Profits are expected to grow 27% in 2015, and this stock only trades for 7 times earnings. There's a current disbelief in profit growth and analyst estimates, and this Ebola thing is absolutely killing the airline stocks right now. And I while I don't want to make light of Ebola, I was around for SARS, and I was around for bird flu and H1N1, and again, I don't want to make light of it, but it's nonsense. And yet at the same time, crude prices are absolutely plummeting, and jet fuel prices, even though a lot of these companies hedge in their future use of jet fuel, the reality is those hedges have to be rolled over, and they're going to be rolled over at substantially lower prices, and that's going to be very, very bullish. So you got double-digit earnings growth, and a single-digit valuation PE multiple. This is a call option trade that anybody can make before the company reports earnings and make triple digits on the trade.
Well, using the 5 keys, let's dive into some of the important numbers that you discussed, specifically the earnings expectations, the sector opportunity, and the future growth opportunities here. So when we put this together, I highlighted some of the numbers for you, so that you could walk through what's important when you review this. And just for everyone's edification, you can get this information on Yahoo Finance, MSN Money, most major financial portals. You're looking for essentially this comes from the analysts estimates tab. If you're in Yahoo Finance, so once you type in a stock symbol's name, you can look down the left side menu and you'll find analyst estimates. And at the bottom of that page is this information here, the growth estimates for the company. But this goes back to the point you were talking about growth, not only now for American Airlines, but also into the future for the company.
Yeah, I think this chart is very telling, and if you're looking for trading ideas, this is a great way to tip your, get a clue to what's going to happen in the future. The stock, compared to the industry, trades for a much lower valuation. It trades for a much lower valuation than the rest of the market. And again, the industry conditions for airlines, I mean, if you've flown on a plane, it's not A, cheap, and B, you know that there aren't any seats available. And that's not going to stop because one person, in a country with, 300 million people, for crying out loud, dies of Ebola, which is horrible. But it's just ludicrous to think that it's going to change the profit outlook for the company.
Well, and to work through a couple of other elements here, folks, keep in mind that two of the important facts for this airline sector, and the reason that we like it so much, number one, labor peace. Despite the recent mergers over the last 6 years, for Delta and Northwest, for United Continental, for American US Air, you have labor peace across all of those companies. You don't have striking pilots, striking attendants, striking baggage handlers, etc. That's an important thing because that keeps airplanes moving. That keeps planes in the skies. So butts in seats, planes in skies. And the second relevance here is no fare wars. Sure, you can use Orbitz, Expedia, Priceline to find a cheap flight, but the reality is that flight costs now are higher than ever. Baggage fees, paying for food on airlines now, that the airlines have gotten smart and they have figured out how to be profitable. They've cut routes, they've reduced their loads, and they've increased what's known as air seat miles. This has made them much more profitable, and it is one of the reasons why those are two of the reasons why we like the airline sector so much. So sorry to soapbox on that, but when you're looking at a company like American Airlines here, you can see, as Jamie's talking about, the valuation, current price to earnings ratio is 6. Against a sector that has an average price to earnings ratio of 23. This is a company that is significantly undervalued. It's recently hit a 52-week high around $44, $45 a share. It's currently trading down in I believe in the low 30s. Beautiful opportunity. They're going to beat earnings not only this quarter but also the next quarter. And keep in mind that as the price of crude oil stays low, that money, that savings, simply flows to the airline's bottom line. I mean, that is literally cash in the bank for the airlines. So if you're looking for trading ideas, not only is American Airlines one of them, and we'll walk through the specific trade for you in a little bit, but there's some very strong basis in fact for keeping these airlines on your radar screen this quarter and next quarter. So a couple of other points on quick keys analysis. We talked about futurations, and this again from that analyst estimates tab in Yahoo Finance shows you that over the last 30 days, for the next quarter and for both the current year and the next year, you can see the number of upward revisions in earnings per share expectations for the company. So Wall Street is starting to catch the scent that these companies are going to produce more in earnings than is currently expected. And this is one of those little sleuthing steps that you can take to position yourself to find the best possible companies to trade during earnings season. So we'll come back to the specific trade a little bit later on again, but right now, as Jamie said, it's an earnings beat for the current quarter. American Airlines will report earnings on October 23rd. We'll give you the way to trade it in just a little bit when we walk through the actual strategy. As Jamie said, this stock is priced cheap relative to its real growth, not assumed growth, and price really should be upwards of that 52-week high, but global concerns pushing the shares lower. And we'll tell you how to get in before that company reports earnings. So next up, Jamie, is Under Armour.
Yeah, and compared to Nike, Under Armour has an incredibly high valuation and is facing competitive pressures from Nike and Lululemon, for example. The stock trades, like I said, for a very high valuation. That valuation requires an almost perfect number when Under Armour reports earnings. And by a perfect number, I mean that they meet revenue expectations, they meet earnings expectations, and that their forward guidance is what the market expects. If there's a chink in any one of those three, you're going to see this stock go down anywhere between 5 and 15%. Could even go more if it's a complete washout. So again, the idea here is we don't know definitively what's going to happen with Under Armour, but the odds and the preponderance of data is in our favor to make a lot of money on a trade if indeed Under Armour reports some sort of a miss. And in this kind of a market, I believe earlier this week we saw somebody like the Container Store, for example, report earnings, or they reported same-store sales, I believe, that missed expectations, and the stock dropped 20%. Now, if you had a call or a put option on that company before that news came out, you would have made a substantial, tidy profit. So with Under Armour, you've got a huge premium valuation, you've got rising expectations against lower consumer confidence. Shares trade for 74 times 2014 estimated earnings. This stock is overvalued, and like I said, any kind of a disappointment, you could see the stock lose at least 10%, if not more.
And again, folks, just to walk through a couple of the quick keys approach here, one of the things that tipped us off to the potential for Under Armour to disappoint and have a significant down move, if you will, is because of their earnings history. And this was the number 3 step that Jamie talked about in terms of earnings expectations, and that's the top bar there that you're looking at difference, where it's been a penny, 3 pennies, 2 pennies, 1 penny. This is a company that when they have their earnings come out, they don't beat their estimates by a great amount. And when you have a company that's significantly valued, that's what Jamie's talking about, where the pressure is on the company to perform. So if there's any miss in revenue, in same-store, in product sales, in earnings, this is a company that could go down rather hard. And you can also see that the expectations by the street for their future for Under Armour are rising. So there's even more pressure on the company to produce a stellar earnings report in the current quarter. And if I remember correctly, Jamie, Under Armour also reports on October 23rd. Is that right?
I believe so, although
okay.
I don't know off the top of my head.
I'm getting confused between that one and our next stock, which was, I think, November 11th. But as you said, you expect a miss due to the choppy retail environment, and the best chance at profits is a put option on this one, correct?
That is correct.
Well, let's move on to our third one. D.R. Horton. DHI is the stock symbol there. What do we have?
You know what's really interesting about D.R. Horton to me, and maybe just the home building sector in general, is that you no longer have regional diversification. It's a very homogeneous market these days. And so what that means is that what happens to one home builder, you can, again, that's the sector trend that you're identifying using the 5 keys. And with KB Home disappointing the market, that increases the odds that D.R. Horton is going to disappoint the market. And again, the summer housing data was not encouraging. You still have very nervous consumers with stagnant income levels. Yes, the jobs market was good last month, but the month before that, it wasn't very good or as strong as people expected. And then you've got that massive overhang of rising interest rates. So put it all together with the valuation being, it's not excessively high, but it isn't cheap either. And so if KB Home missed estimates and the stock dropped 6 or 7%, you're going to see DR Horton do the same thing, and that's what I expect. Just like they did in June when they missed earnings by 34%.
All right, let's take a look at some of the quick keys analysis that you've done for DR Horton here, and I'll let you take over here. What are the things that have been jumping out at you the most?
Well, with DR Horton, the current estimates are the same as the prior quarter. That can happen for any number of reasons. Wall Street is loath to punish a company in any way because they're trying to earn future business from that company in the form of investment banking opportunities. And so, that's a little dirty secret of how Wall Street operates. And so with DR Horton, I think that tells us a lot that the estimates are the same, even though the news was relatively poor. Then you have that really bad miss from the quarter prior. In the last 3 months, housing data was mixed or negative. And if you place a put option on this stock in advance of earnings, again, nothing's a guarantee by any stretch. But if you can buy that put option, they disappoint in their earnings, and the stock drops 5 to 10%, you've got yourself a triple-digit winning trade.
All right, that's the wrap on the three companies analysis. Now let's talk about the trading plan, and just do a quick review of the three trades that folks should be placing and the way that they should be placing them.
Right. So this is how we, with the earnings player, how we advise our subscribers to place these trades. For American Airlines, we're using very simple call options, the weekly call options. The same with Under Armour, we're using put options, the weekly put options. DR Horton, we're using put options. Now, what you want to do if you're going to place these trades, remember, we're isolating the earnings event. We don't want to deal with any nonsensical Ebola crap or market fear or market crash or what have you. I mean, you saw the market go down today, and United Airlines actually was up over 2% today. That's why this is such a reliable program. If you get the analysis right, you can. It's probably the only thing in the stock market that you can count on for that one day. Trading is going to be focused on earnings, not the other nonsense that goes on. We use at the money or just in the money options, and again, we mentioned the secret sauce, if you will, for this program is that we're using weekly options. Now, what that means on the flip side is if we're wrong on these trades, do keep in mind the potential is that you could lose 100%. You can lose your entire capital base. But we've got some strategies to deal with that in our earnings player program that I think are very compelling, that mitigate that risk, if you will.
And just to recap here, the reason that we use the weekly options instead of a monthly option is we don't have to worry about getting the month right. And neither do you. When you're using a weekly option, because you, as Jamie said, because you're zeroing in on that individual event in that moment in time, you're getting the maximum potential impact by using a weekly option rather than trying to guess which month options you use down the road, next month, quarter month, what have you. And you also get a much greater impact in terms of the price movement to the premium of the option movement. So that's why we're giving away our secret sauce in the terms of using weekly options. But the other reason here, or the other element here, is the reason we use just a straight call or put option is for maximum risk and maximum reward possibilities here. Yes, your maximum risk is 100% of your premium, and we'll talk about that a little bit in just a couple of slides. But your reward is unlimited in the sense that if the market starts moving and a stock jumps or falls 15, 20, 25%, and it does happen, and that's how we pulled a 500% winner out of AOL. When that stock dropped 15%, that option went up over 500%. So if you try to use other strategies like spreads or straddles, etc., yes, you're going to mitigate your risk, but you also significantly reduce your reward potential. So we also keep our exposure minimized by only targeting 5 trades per week. So we're only looking at the best 5 highest probability trades each week during the primary 6 weeks of earnings season. So in this case, we've given you 3 trades. And again, just to recap, American Airlines reports on October 23rd. The same day, Under Armour also reports. D.R. Horton reports on November 11th. So the way that you would approach this, because it's a weekly option, is to look at the day of the week that earnings report occurs, and then buy that option, whether it's a call or a put, before that earnings event takes place. So, for example, if the company reports on Wednesday, you might buy your weekly option on Monday or Tuesday. If the company reports on Tuesday, obviously you have to buy it on Wednesday. Wednesday. You have to buy it on Monday. And then the way that we exit our trades, we'll cover this again in a little bit, is once the earnings event is now known, so once the company's report is out, we then let roughly the first hour of trading occur, and then if it's a losing trade, we'll simply exit the trade. There's not much you can do. And that can happen if a company surprises. That can happen if the market is suddenly negative, even though the company beats. We've seen all sorts of iterations take place. But more importantly, if we're right on the earnings and if the stock is moving in the right direction, we typically let that trade run until about 3 p.m. and close it out before the end of the trading day. So you can use this. It's not day trading, but you can use this strategy with those 3 companies, and you'll see in a short bit here how well we've done. But right now, before we get to questions and answer, as I said, I wanted to make sure that we extended our invitation to join the Earnings Player program. So Jamie, hang on for a couple of minutes, and I'll bring you back in to do Q&A with me. Actually, I have a couple of slides in here that I know you want to be able to jump in and add some things to, so I'll make sure to give you an opportunity to talk to people about things like the capital management approach and the trading process. But the Earnings Player is essentially focused on the primary 6 weeks of earnings season. That begins next week and runs through the middle of November. And when I say primary 6 weeks, I'm talking about when 80% of the S&P 500 report their earnings. And of those 80%, the vast majority of those companies also have weekly options available. So that's why we focus in on just those 6 weeks. Now, other companies certainly report during the quarter, and from time to time we may put out a bonus trade to our members, but the best action occurs during the next 6 weeks after Alcoa and Google kick things off this week. So Alcoa reported yesterday and beat, and I believe Google reported, did they report tonight or did they report Friday? I don't remember. We'll have to look that one up. But at any rate, they are the conduits to getting the ball rolling with earnings season. So what we do is focus on the first 6 weeks here. So we're going to start our next season on Monday, October 13th. That's next Monday. And that will run through the end of the week, November 21st. That's a Friday. So those 6 weeks. And what our members get are weekly options trade recommendations. We typically target 5 companies. From time to time, we may only be able to put out 3 trades, but you're typically looking at 3 to 5 trades each week, which we deliver to our subscribers by email every single Monday by noon Eastern. Now, that's important, and as we talk about the trading process, you'll understand why, but it gives us plenty of time to analyze the companies that are reporting each week and then do our data analysis to get down to the 5 highest probability trades each and every week. Now, the trade recommendations are just as we've shown you with American Airlines, Under Armour, and D.R. Horton. They are simple options trades. You're either buying a put or buying a call. We'll give you the specific entry instructions, and then once the earnings event is known, follow up and give you the specific exit instructions. So you're never alone. You know exactly what to do with each of the trades that we put out. And as I said, this is not day trading. The irony here is you're actually crossing over 2 trading days. It takes maybe 10 minutes total trading time for each of your trades, maybe not even that really, but it total 30 minutes a week. That's about what it takes. 5 minutes to put the trade on, 5 minutes to close it for each of the companies, and you're done. So that's as simple as we've been able to make it, and we keep it that simple because we found that gives us the maximum opportunity, the maximum profit potential when earnings are reported each week during those 6 weeks. So again, and Jamie, you're welcome to jump in if you want to add anything in here, but again, you're going to buy a call or a put at the money or just in the money, you're always using the current week's weekly option. Now, weekly options are posted every Friday for the next week. So the earliest you could buy them is on a Friday for the next week's close. We typically will wait, however, until the last hour of the trading session just before the company is due to report earnings. And that's important because what that allows us to do is to take out most of the market noise during the trading day and even the days before the earnings season, the earnings report. And what I mean by market noise is a day like today. You wouldn't necessarily want to be putting a call option on a day like today for something that's going to expire next week because the market just really fell through the floor today. But where we have had success is by placing that trade at roughly about 3 p.m. just prior to those earnings announcements. So company is reporting after the bell, you're still placing the trade at 3 p.m. the same day that they report. Or if they're reporting before the bell, then you're placing it at 3 p.m. the day prior. So again, this is how you prevent yourself being classified as a day trader because you're not going to close that trade out until the next day. So if the example here for yesterday really was Alcoa reported Wednesday after the market closed, so you would place your trade between 3 and 4 p.m., or would have placed it yesterday, and then you would have, to see how they had done today, you would have checked in around 10:30 this morning, and once you knew what their report was and what the market action was, you'd be able to close that trade out either 10:30 or as late as 3 p.m. Of the same day. So again, if it's a losing trade, we typically try to close those out immediately, and if it's a winning trade, generally we'll let those run until 3 p.m. of that next trading day. So Jamie, I know you've talked in the past about the importance of being able to close those trades, letting those winning trades run sometimes, but also sometimes you close those winning trades out a little early as well. Can you explain why you do that?
Sorry, John. My computer is a little slow, and you faded out. What was the question?
That's okay. I'm just going to move on. We'll just keep going here. 10/16. Thanks, Tom. Google reports on October 16th. I don't know why I thought they reported this week. All right, so here's an example of exactly what you get as a member of the Earnings Player program. Again, you get the weekly Earnings Player trade selections, which include up to 5 trade recommendations each week for the 6 best weeks of earnings season. You get Jamie's insight and analysis using the 5 keys on each of those recommendations, so you have a rationale for making the trade. And then you also get the overall expectations for the earnings report. Is it going to be a miss? Is it going to be a beat? And then the specific weekly options trade instructions, including the entry day, the entry time, and the entry strike price. So our best example here, AOL, our 500% winner for the year. You can see we told our subscribers to buy the AOL May 9th $44 puts before the market closed on that particular Tuesday, and then we closed the trade out at 3 p.m. the next day. As well, we also, again, I told you before, you're not alone. We keep up on all of our open trades, and as part of that, we do what we call our daily email updates. So Tuesday, Wednesday, and Thursday, and sometimes Friday, if we happen to put a trade on a Thursday, you'll also receive a daily email update covering the open trades with specific exit instructions. Now, we're generally going to follow the same rules. That's closing a losing trade within the first hour. I have 9:30 there. You can close it anywhere within the first hour of trading. That's if the company's report is completely opposite, or if the market is simply not moving. We just want to move out of that trade as quickly as possible. Winning trades we typically want to let run until 3 p.m. So our daily email update will come out just after the market open, and it will tell you exactly what to do with any of the trades that we have on or open on any of those given days. So just some examples during the course of the year here over the last 2 quarters. I want to share some of the results that we've had. These are some of the Money Doublers Plus, 100% gains on Yahoo, Qualcomm, a 156% gain on MGM, 172% on Coach, 176 on Fossil. You can see a wide breadth of industries here, and you'll see more on the next chart. These are some of the most exciting trades that we've had over the course of the day, and I'm not giving you all of them. Yes, and again, we will always stress that we do have losing trades, but you already know your maximum risk in advance, and overall, during the last 2 quarters, Jamie's averaging about a 60% win rate on his open trades. So it's a very strong program in that regard. You have a very good opportunity to put money in the bank each week. We'll walk through some of the very specific rules here as it relates to capital management in the next couple of slides. But again, some really big winning trades here: Whole Foods and InvenSense for 201% each. Baidu, 268%. That was just last quarter. So was Canadian Solar, which was a 400% winner. And the retailer Cons, which was also a 426% winner. And then our big money winner, I've talked about it enough, America Online with a 525% gain. Now, the most important aspect of this, if you join us, is to understand the importance of capital management. And as Jamie likes to say, and I'm going to start sort of at the bottom here and work my way back up with him, you need to make sure that you stay in the game. And that means you want to have and make sure that you have enough capital to get through all 6 weeks. And the reason for that is we don't have any way of knowing which trade will be that 400 or 500% winner. Now, once the earnings report is made, once the market reacts, then we know. But there's no way to predict the actual market response. I'll give you a really good example of two frustrating trades that we've had this year, both on the same company, Gilead Sciences. If you happen to know Gilead, you know what they do. And the frustration with that company, both times the analysis spot on, 100%. Completely accurate analysis by Jamie. Both times he predicted the company would blow out earnings. Both times the company blew out earnings. And both times we made those call options, the stock didn't move. So sometimes you cannot predict what the market's reaction will be. So even though we had all of the ducks lined up correctly, it was the last duck that just didn't fall in our favor. But that's the importance of having a capital management plan. And by capital management plan, I mean just making sure that you have enough capital week to week to make the 5 trades. Now, you don't have to go all in here, folks. There's absolutely no reason to do that. As Jamie said earlier, earnings season happens 4 times a year. So use this as a way to generate extra capital to your account rather than trying to swing for the fences. Don't use anything more than 1 or 2 contracts per trade. It's not necessary. Over the course of 6 weeks, if you hit on 50 or 60% of your winners, you're going to make more money by betting less, if you will, by taking fewer contracts per trade than if you tried to go all in and hit the 1 home run trade. So keep that in mind. Remember, we're going to be putting out a total of 30 trades over the next 6 weeks. Now, you don't have to have tens of thousands of dollars to be able to do this, as Jamie said, and as you can see on this little chart here, some of these options premiums to buy are actually pretty low. So to buy the MGM option that you see on the screen there would have taken you $78. Remember, you take the premium price multiplied by 100, and that's the amount of capital you need to buy the option. So you could have bought one MGM, I believe those were calls, actually. You could have bought one MGM call for $78. Now, the EQIX was a much higher premium option, so that would have required $1,090 in capital. But you can see the spread here is wide. There are low premium options, but they still generate very significant returns, and sometimes there are high premium options. So you want to estimate or plan for about $1,000 to $2,500 in total capital each week. Now, remember that your capital is only tied up for 24 hours, assuming, of course, that the trades are not 100% losers. And what I mean by that is because you're using a weekly option and you're going to exit that trade the next day, you'll have that money available the very next week. So you can also roll your gains into the next week's trade. So if you're starting really small, 1 contract, you'll be able to move yourself up a level to a couple of contracts. But again, please don't bet big on any of the trade. And Jamie, I know you always like to chime in on this chart.
I do, because this is so critical. You know, a lot of times, you know, if you're new to a service like this, you're going to come in and you know you get all excited. You believe in what we're showing to you. You want it to work really badly, and the first week comes and I give you 4 losing trades and 1 winner, and then you get mad and you ask for a refund, and we don't want that. You know, you've got to play the game over the entire 6 weeks. And if you're consistent, and I'm going to disagree with John a little bit, where he was saying you absolutely can roll up your profits into future weeks. But what I like to do, and some of you I noticed in the chat are asking about the overall win percentage, and I'll get into that in a second. But Tom is asking the question: if you're starting out with $9,000, okay, what should I be committing to each trade? And that's a great question, because it's how much you should allocate to each trade and be consistent with that over the entire course of the 6 weeks. Because like John said earlier, I don't know when that 500% winner is going to come. I just know it's out there. And I kind of equate it to game fishing, sport fishing, looking for that marlin or the swordfish. You've got strategies to go out there and find the fish, but it can take a while before you identify it, and you might get a couple on the line and you lose them for whatever reason. Same thing can happen here. Although I don't want to be too Debbie Downer on you. It very well could be that 500% winner is in the first week of trading too. So by having a consistent trading strategy, and Tom, the answer to your question is I would look at $500 per trade with that dollar amount that you're starting with. If we do 25 to 30 trades, I think with $500 you've got the opportunity to take that $9,000 and turn it into $12,000 to $15,000. So it's about being consistent each and every week.
And a couple of our members from the past have written to let us know how well they have done. Here's a good example from Michael. He had back-to-back weeks of $2,700 gains, and he continues to come back every quarter. We appreciate that. We appreciate him letting us know. And then Jay Nelson, I actually have him over here. This is a good example of the kind of experience that members have had. Triple-digit gains, double-digit winners, and an overall gain of 40% in his trading account in just over 2 months. And that's why we focus on those specific 6 weeks, because they are the 6 weeks that give us the best profit potential every single earnings season. So again, here's I'm going to try and wrap up so we can get to more of the Q&A here. Here's again what's included in the private trading program. It's the Earnings Player's top 5 weekly trade selections during the 6 weeks of earnings season. I know I've beaten that to death. Up to a maximum of 30 trades, although from time to time, if Jamie sees some additional trading opportunities beyond those 6 weeks, he will let you know as a premium subscriber. You also get the daily email updates on the open trades every Tuesday, Wednesday, Thursday, and sometimes on Fridays. And then we also do a weekly wrap-up email at the end of the week, which includes a sneak peek into the next week forward as to what we see happening in the market that could affect some of our trade opportunities as we move forward. So there's going to be a deadline of Sunday night, 11:59 p.m., and that's because our first hot list, our Earnings Player hot list, will be out on Monday at noon Eastern. Now remember, the earliest you might have to place a trade, depending on what trades Jamie selects next week, would be 3 p.m. on each Monday. That's the earliest you would have to place a trade. So we try to make sure that you get the hot list by noon so you can have your trade ready to go by 3 p.m. if there's a Monday trade to put on. Generally speaking, you're going to find that most of the trades are placed Tuesdays, Wednesdays, and Thursdays. So there's more than enough time for you to go through the hot list, know which trades you're going to be ready to place, and then follow those trades through with the email updates during the course of the week. Now, normally we have a regular price on this of $349, but I told everyone yesterday, and everyone here can thank Google and YouTube for this one, but we're actually extending our special for the Earnings Player quarter of $149. We did a web special yesterday, but you folks are all lucky because the replay, for some reason, had technical issues on YouTube, so we had to redo the whole webinar here tonight. So congratulations, you're all eligible to save money again. It's our gift to you. Thank you, YouTube. So these things happen, but again, $149. What I'm going to do right now is, if you look over in the right sidebar, there's a little pop-in box that will come up for you that you can click the yellow button that says Get Started. That'll take you right to the reservation page.
John, can I chime in?
Just hang on just a second, Jamie. We do limit this to 150 traders, and as of yesterday, we had 35 join, so we're at about 95 seats still open. that runs through the weekend. So you want to make sure that you get your seat tonight so you're ready to go on Monday. We will send you, for those of you who asked for it, we'll send you a replay so you can certainly take some time to consider if this is going to be right for you. But you want to make sure you get your seat right away. We will have a couple of little bonus things going out over the weekend. Everyone should have gotten their preview report. If you didn't, I'll be making sure you get it on Sunday. So make sure that you grab your seat right now. I'll also put the link up in the sticky admin message, which will appear in the chat, so you can click that link if for any reason you can't get to the pop-in button. That'll take you right to the reservation page, so make sure that you get your seat immediately. And the price will be going up this weekend, so that's why I want to make sure that everybody gets the $149 special, especially since you spent your time with us tonight. Again, it's our way, and that's when you do the math backwards, that's the equivalent of $5 a trade. It's actually $4.96. So it's like paying a small commission to get a high probability trade opportunity. And again, we'll follow those trades all the way through from start to finish. You're never trading alone. You'll always have the instructions you need. And that's everything we have so far. I'm going to, Jamie, I know you wanted to chime in with something, so now is your chance.
Well, all I was going to say is that I do take tips.
Don't take long walks off short piers.
No, I'm just kidding, of course. We were talking about the blame Google for that 149. Well, now.
All right, so let's do a couple of the questions here so we can get everybody out as quickly as possible. Eli asked, weekly options, when do you buy? So we did cover that, but just to recap it again, we are buying those options at 3 p.m. this trading session prior to the earnings being released. So if the company reports after the market close, you would buy the weekly option at 3 p.m. of that same day. If the company reports before the bell, then you're buying the option at 3 p.m. the day prior to the earnings report before the bell. So great question. Thanks again for asking us. And you're buying, John says, you're buying an option at max volatility. It is the most expensive option. I understand market noise, but not at the expense. John, that's a good point. It's a fair point. We're not necessarily because we're also buying those options early in the week. Sometimes buying those options early in the week. Because they're weekly options, that they're going to move a lot faster no matter what. So you can't necessarily buy them a week ahead because you have to do the analysis leading in. And part of the analysis that Jamie does is to also use the most recent trading data, which includes the current week, or the previous week. So it's one of the reasons why he does his analysis over the weekend and then releases his report during the week. Now, you could buy the option earlier in the week, but we have simply found that generally, that for our purposes, buying the option the day before has produced the best results for us. But that's not to say that you can't test that out and let us know how you do. But thanks for the question and the point. I do appreciate that. Jamie, I think you took care of Bruce and a couple of other folks who were asking about the average. Well, actually, this is average winning percentage, which generally speaking is about 150.
No, I didn't answer the question, actually, now that you mention it. I was going to, but I forgot. So the last 2 quarters, which I think I've been doing earnings recommendations in this form for going on 3 years now. The earnings player in it as constructed we've been doing for 2 quarters. And in that way, our winning percentage, and it's the same. It's generally the same, although I haven't kept track previously, but we have kept track over the last 2 quarters, and we're right at 55%. 2 quarters ago, second quarter earnings or first quarter earnings season in April through third week of May, we were at 70%. I mean, we had a fantastic quarter. Last quarter, we were only at 40%. But if you're a numbers person and you realize that you're only losing 100% on these trades, sometimes you lose less. We are able to close them out, with some salvage value, although not often. But when you hit that 300 and 400 and 500% winner, that makes up for 5 losing trades. And when you're only trading 25 trades, 25 to 30 trades, you don't have to have a 50% or better hit ratio to have this program put cash in your pocket. And that to me is another reason why this is such a neat little, and don't tell anybody, I want it to be our secret. So it's a great program. And it's a lot of fun too. I mean, there's you watch the stock market and I get that what goes on there, but there's nothing like these earnings trades. It's a rush. It's a rush to be rewarded for your good analysis, and not only get rewarded, but to have that 500% winner. It's just a lot of fun. And if you like that adrenaline rush, you should sign up. You're going to have a blast with this program because it really is fun. And some of you that have been here before, feel free to chime in. Tom did. First quarter, you guys killed it. Mean reversion last quarter, no problem. Yeah, and the mean is pretty good at 55%. Your winners winning more than your losers lose. Again, you're still putting, you still come out ahead of the game, and it doesn't take a lot of time. It's not capital intensive, and I've got my 73-year-old mother playing this game, and she's been bugging me for the last 2 weeks. When do we start? When do we start? When do we start? Last quarter she actually. She missed out on a couple trades that were actually losers, and so she actually put money in her pocket last quarter that allowed her to take a trip out to California. And that, for someone that's retired, to have that little extra cash, it's a really cool thing. So anyway, it's hope to see you guys come in.
And Tom did just sign up. So Tom, welcome to the program again. Good to have you back. And Carlos asked, what is the base total account balance? I assume that you're asking, Carlos, how much capital you need. And again, and in most of the weeks that we've been running Earnings Player, the maximum, just to buy one contract, the maximum amount that you've typically needed is about $1,500. For most weeks, you can actually do it with far less. We've had weeks where to buy one contract, the capital commitment is between $500 and $800 across the 5 trades. So it's not like you have to have tens of thousands of dollars to start with this. You can start with a small account. That's one of the values in this program is you get to build up a small account. But you don't have to start with a ton of money. You can start with, as I noted on the one slide, even if you start with the first week with about $1,000 or $1,500, you'll still be able to take the trades. And if there happens to be a high premium trade, you can balance out your account based on that if necessary. John asks, you recommend buying just before earnings report and sell soon after the announcement. With this, wouldn't implied volatility work against the trade? And the answer to that is no, because implied volatility can't predict the market's response to the earnings report in and of itself. And that's the event that we're focused on. Jamie, anything you want to add to that?
Yeah. I know it may seem like you're buying at the absolute worst time, but trust me, over 3 years of doing this, despite that implied volatility, there is still money to be made. So what I do, and I do a little calculation that tells me how much the stock needs to move for us to make money when we place the earnings trade. And oftentimes I'm looking at if there's enough premium in there where it's say between 3 and 5%, I'm going to make the trade. In other words, so if a stock that tells me the stock has to move more than 3 or 4% for me to break even, and then everything above that percentage is pure profit. And so, when you get a stock that moves 20%, even if the implied volatility is super high, it ain't 20% high. So there's still meat on the bone, if you will, to make money.
It ain't?
It ain't.
It ain't. I don't think I've ever heard you say ain't. But let's see.
It's late.
Like I know. Yeah, but you're an hour behind me, so you don't have that excuse.
True.
Henry says or asks, do you hedge with spreads? And no, sir, we do not. And the only reason we don't is we're looking for the maximum possible reward. If you know what you're doing when it comes to options trades, you can construct your own spread trade based on the information that we give you. However, bear in mind that a spread trade is going to significantly limit your profit potential. The value in a spread, obviously, is that it reduces your overall risk, but as compared to buying a straight put or call option, but it's that the getting those big winners to really to 200, 300, 400%. If you are using a spread trade, you're generally not going to get those numbers, and that's why we don't do them. And the other reason, from sort of a less technical perspective, is because we want this program to be accessible to any level of trader, or a call option, a straight option, is an easy enough trade for any level of trader, especially a newer options trader, to make. That's yet another reason. But again, our results have shown us that buying the option as a put or as a call have produced the best results over the last 6 months and beyond, in the years past when Jamie has been doing this as well. Michael asks, on options, how can you tell it's a weekly option? In the options chain, it will give you the weekly date. For example, if Friday is what is Friday? The 10th, right? So if I think the actual expiration date is a Saturday, so you would see the Google October 11 option, $65 option. So in your options chain screen, you'll see that it's a weekly option as opposed to a future option in November or expiration of October. Now remember, one key point is third week of the month. Beautiful week of the month. Beautiful week of the month. And everybody who trades options should know why. Because it's options expiration week. And the dirty little secret about that third week is in that week, every option is essentially a weekly option, which means the third week of October, the third week of November, which we should be able to hit both of those in this quarter, opens up far more trading opportunities for us because of the expiration Friday. So just a little technical note for everybody to keep in mind, as a little more profit potential as we get down there. Brad asks, can I get the same subscription price as Jamie's mom? I'll let you answer that one.
No.
Carlos says, why don't you go slightly out of the money, bigger percent? As Jamie alluded to, he's looking at how much the stock price has to move in that 3% range for the option to be essentially break even to profitable, and then everything above that is essentially pure profit. If you go too far, or even if you go slightly out of the money, you're putting more pressure on the stock price move to get you to a profitable position. Whereas if you are at or just in the money, you have less pressure because once the stock price starts to move in your favor, the option is obviously already moving. Whereas an out of the money option, the price has to catch up before the option price really starts to move. Now, Jamie, anything you want to add to that one?
I do. Because the option market now is much more liquid than it used to be, you don't have discrepancies in contracts across strike prices as much as you used to. And with weekly options, it's de minimis. The difference, the percentage gain, whether you buy the contract that's out of, $1 more out of the money or not, is just not going to make that much of a difference. And so, for simplicity's sake, and because we have, obviously a lot of customers that are following these recommendations, we just stick to the at the money or slightly in the money options.
And let me just catch up on a few little notes here. Brad, you're welcome. He says, thank you guys for the webinar. You and everyone else are welcome. Don't forget to take away those of you who choose not to join, and you're certainly under no obligation to join. Please don't forget the 3 trades that we've given you here tonight: American Airlines, Under Armour, and D.R. Horton. Again, October 23rd reporting dates for American Airlines and Under Armour, and November 11th for D.R. Horton. And remember, you place that trade the day before. That's a call on American Airlines, a put on the other two stocks, and then, again, see how that trade does the morning after. And then when you've made money on those three trades, we fully expect that you will come back and join us for the earnings player in January 2015. And that's my humorous moment for the day. Let's see. Tom says, Mom is a born riverboat gambler. Yes, indeed she is. John, no, sir. Jamie is not a licensed professional, which is why we provide all of our information as essentially under the First Amendment, if you will. We make recommendations. We do not tell you how to manage your money. We give examples of how to manage your capital, such as we've shown you in the webinar here today, but we cannot tell you specifically how much money to put on a specific trade. We can give you what we believe a trader should do, but we cannot give you specific financial advice in that regards, and that should not be taken as a negative. As I said at the outset, Jamie has over 25 years of experience in the stock market. He's been in the investment newsletter business, sort of making recommendations to investors and traders for the last decade. As I noted earlier, Hulbert Financial Digest even ranked one of his newsletters a #1 newsletter in its category. And he currently works with me on the Millionaire Blueprint program, which is a portfolio building program. And that's how we operate. So thank you for the question, and I hope you understand our answer. Next up here was Tom. Does any work done any work on nearest out of the money rather than at or in the money? We haven't yet, Tom. One of the things we're actually going to test outside of the program this current quarter relates back to one of the other questions. I apologize, I forget who asked it, about buying the option earlier. One of the things that we may look at testing on our own for future versions of, or for future quarters, is buying the option actually a day or two earlier, just to see what happens in terms of the price. Keep in mind, folks, that one of the reasons that we keep the buying of the option so close to the earnings event is to eliminate overall market noise. And again, you want to capture as much of that singular moment in time as you possibly can. If you trade too early, let's say you're buying a call option and we get a bear dump on a Friday, say you buy the call option on a Friday, and the market goes down 300 points. Well, you're significantly underwater on that option, and then you have your option may be down to almost nothing. Well, then you're faced with the problem of what I was talking about earlier as it relates to out of the money options. Is now the price has to catch back up to the level of your option just for you to be at break even. Well, if you're underwater 2, 3, 4, 5 days out, that's too much pressure, too much price pressure to expect based on an earnings report. So if the overall market, so that's why we want to eliminate the overall market noise and be as close to that earnings event as possible. So again, the one thing that we're going to test is actually looking at those options one day prior, but we're not going to do that with subscribers right now this quarter because we have not pre-tested it, if you will. So we're going to pre-test it with Jamie's mom, and we'll let everybody know where she takes her next trip to. Hopefully it will be like Bora Bora and not Minneapolis. So let's a private question here from a webinar attendee here. Day trader, make trades in the $4,000 to $5,000 per position. Are you suggesting that I cut back on this? Jim, in your own capital management day trading element, seems you know what you're doing. As it relates to the earnings player, the reason that we suggest keeping your exposure limited, in part it's for smaller accounts. It's to ensure that they can get through the full 6 weeks of the earnings player, because we have had quarters where the first week you run into the market running the exact opposite way of some of your options trades, and so you have to have enough capital to be able to make it to all the way through the season, because we might have I think back in the second quarter, here's a good example. We had 1 winning trade in the first week and 4 losing trades. I'm sorry, it was 2 winning trades, 3 losing trades. But the net effect overall was a break even. So the 1 winning trade was 100%, the second winning trade was about 80%, and then the 3 losing trades totaled 180%. So you break even after that first week. The second and third weeks, all of a sudden, we were hitting 3 and 4 out of 5 winners per week. So if you bet, if you go too far in the contract phase on that first week or first 2 weeks, and just the market isn't cooperating for any reason, you run the risk of not sticking it out, if you will, not having the heart. And I don't mean it that way, but you might just give up. It's understandable. It happens to folks. Folks have seen it. So that's why I try to stress, keep your exposure small. If you've not traded with us in the past, please keep your exposure small. Learn how we teach, how we operate, how we make our trades, how we recommend our trades. Excuse me. We'll learn the rationale behind our trades. But the biggest thing is, this is, well, as powerful as it can be, as Jamie said, and I know as I've said, we never know which trade is going to be that big winner, or which trades will be those big winners. And I know, here's what's going to happen, is you're going to get in there, Jim, and we're going to have like that 1 week where every trade hits 200%, and you're going to kick yourself saying, I could have bought 10 contracts of each of these, and I'd be flying with Jamie's mom to Bora Bora. And I know how hard that is not to, and that's the natural emotional response. And the opposite is true too. You could lose 5 trades and I lost everything. I'm not doing this again. But that's why I stress the keep it small. Trade with us. You will find as you go through the quarter that we're going to find those winners and those nuggets, if you will. You may not turn a 2,000% return in 6 weeks, but also you don't have to. I mean, if you're a day trader and you already know what you're doing, and to me it sounds, based on the way that you've you worded your question, I think you're doing just fine. This should be sort of like almost like a break from day trading for you, in a sense. It's a small speculative trade in addition to other trades that you're making that you can put on. So I just, and I don't want anyone to take away my words of caution as it relates to capital management as like, oh, you're going to lose your money. First of all, you will have a losing trade. It's guaranteed. I promise you, you will have a losing trade. My point is that you have to balance the reality or the probability of a losing trade against the probability of a big winning trade. And that's where capital management comes into play. And one of the things we're going to be doing in our Monday reports is giving everyone an example of the capital management strategy. So as Jamie puts out the 5 recommendations, you'll actually see sort of a minimum amount of capital required each week for the 5 trades, and then each of you can make your own decisions about whether you're going to make 1 contract, 2 contracts, maybe 5 contracts. But I would, again, let the first couple of weeks get through and see. Let's take stock as we go through each week. Jamie will give you that kind of guidance in terms of keeping your bets intelligent. And I apologize for the long-winded answer there for everybody. So I know it's getting late, and Jamie,
I want to expand. Just, I know we've pounded it to death a bit, but it really is important to stick to the capital management plan. And again, don't that's not a negative thing. It's actually a positive. I mean, the last quarter, not the last quarter, but 2 quarters ago, if you put $500 into each of the 20, I think we had 22 trades in that quarter, you would have netted out close to $5,000, or maybe even a little bit more. That's net in your pocket with $500 in each trade. Now, obviously, if you do the math, $1,000 per trade, it's $11,000. Now, last quarter, if you placed every trade, you would have, depending on if, we had, there was one trade last quarter that it was that had a super high cost that we won't be making those kinds of recommendations any longer because of the capital management program and the emphasis on the capital management program. Like the trade, love the trade, but it didn't fit the capital management program and shouldn't have been a trade. And for those of you who were there, that was Chipotle. I think actually Tom might have brought up the question about Chipotle, that you took a pass on that one because it was a contract that would have cost you $2,300 just for that contract. So if you, in a world of putting $500 into each trade, that obviously doesn't work. So part of my job and focus now with this capital management program is making sure it fits into kind of the average, whether it's $500, $1,000. But you can still. I like to think of this as an income generator. As strange as that may sound, I've used the term income generator with this program before, because if you play the 6 weeks each and every quarter, you could put a few $1,000s into your pocket, and that's substantial if you're a retiree, whether you're a retiree or somebody that's building up net worth. So, but stick to the capital management program.
And quick note from Hal here from last quarter, and hopefully Hal, we've helped to clarify that in our email sequence. Our email updates will also make absolutely clear when to be exiting trades. But Hal chose his own exit points. He says, I always got out of the winners whenever I liked the amount of profit. And that's absolutely the right approach to take. Even though we may let a trade run until 3 p.m., if you get up to 250, 300% on a trade, and you're just, hey, that's good, that's enough for me. That's a good approach. Remember to balance fear and greed. And by balancing, that means when you sort of start to get nervous that option is maybe it's run its course, there's absolutely nothing to stop you from taking that profit. Taking profits, no matter what size, is always a good thing. So thanks for sharing that, Hal. I appreciate that. Paul, I see you got your email. Okay, good, Paul. Thank you for letting me know that, and I'll make sure that everybody's getting those confirmation emails. I'm not sure if I'm pronouncing it right. I hope so. Parag. Will the 3 trades mentioned be included in the upcoming earnings player, or are they in addition to the recommendations that will come with our subscription? They are in addition. We are giving them as complimentary trades so that everyone can get a sense of the earnings player. If we do include them, it will remind people that they are up in a particular week. They would essentially act as a 6th or 7th trade, the week of the 20th and the week of the 8th. Of November, I think it is. So we'll remind folks who are members, but again, they were complimentary trades so that everyone could understand the process that we go through to make these trades, but more importantly, to give folks really a freebie, a way to play 3 good companies that have some potential for reward. So thanks for the question. I appreciate that. Henry, I sent you a private message in regard to your question. Jim, I get it. Okay, thanks. We are all set there. Tom says, look at how much you can lose before you look at how much you could make. Again, another rational approach. Really appreciate that. Rich says, correct, especially in weekly options, the Greeks will kill you. Yep, delta, theta, alpha, beta, omega, etc. Vega. How many? I hate the Greeks. Thankfully, it's not Latin, though. I think the best strategy, he says, is as you have it, and that is right before the earnings, even though implied volatility be at the highest at that point. This is why volatility crush, otherwise known as VC, happens right after the earnings release on those trades that don't work, or on the fence like Gilead was last quarter. Rich, that's terrific. I thank you very much. I hope you don't mind if I borrow some of that for future Q&A and for future training elements to include in there. Again, I'm going to read that again for everybody so that everyone understands where we were talking earlier about the purpose of buying the option as close to the earnings event. Rich, one of the webinar folks here tonight, said, especially in a weekly option, the Greeks will kill you. That is delta, theta, and the rest of the Greeks. I think the best strategy is as you have it, and that is right before the earnings, even though implied volatility will be at the highest at that point. This is why volatility crush, also known as VC, happens right after the earnings release on those trades that don't work or are on the fence like Gilead was last quarter. And Gilead was the frustrating trade that we made not only last quarter but also in April, and both times the call options just didn't move for us. Again, Rich, thank you very much for that. I really appreciate that. Thank you, Henry. Nithy, AA beat expectations, but stock tanked, and that's because that's actually an example of the market essentially affecting Alcoa as opposed to their earnings. Now, when the market, remember, right now what we're looking at is a market that is in an extreme state of flux, and I'll give you the top 5 reasons why without diving into the economic details or the economic weeds. Number 1 is Europe. You still have significant growth concerns in Europe. The reason that the Dow, and Alcoa is on the Dow, the reason that the Dow is down 300 plus points is you're looking at all multinational global corporations. China. Number 2, global growth in China is of a major concern. So where these companies now are relying on profits from Asia and from Europe, those profits are at risk. So even though the company beat expectations, it's the forward guidance, if you will, the forward expectation now of the stock market. It's something that we are going to be very watchful of as we make our trades this quarter, because in addition, obviously, you have the threat of interest rates increasing next year. You have the dollar, which has risen to unbelievable highs, and you have the bond market, which is still in a bullish run, despite the fact that yields are at historic lows. So those 5 things right now are all working in tandem against the stock market right now. Now, any one of those dominoes could fall the opposite way. If the ECB suddenly decides they're going to do a Fed-like QE program better than the one that they just implemented, the market will go nuts. If China suddenly reports 10% growth, the market will go nuts. If the Fed, as the Fed continues to end its bond purchases this coming month, now all of a sudden the bond market no longer has the Federal Reserve basically propping prices up. That's a questionable sign. You have oil prices down, which actually should be a good thing for a number of stock sectors, but it's not priced in yet. So there are a number of factors that can sometimes, it's a good example. Yeah, they beat expectations, but the overall market was down so hard that the market ignored it. But at the same time, as Jamie pointed out, there was Little United Airlines increasing their forward guidance, and their stock went up. So it's a challenge sometimes to predict how the market will react, but it's yet another example of one. It's also an example of why we wait until the second week when we have more choices for trading earnings. I don't think we've ever traded Alcoa, and that's a good reason why. They're always first out of the gate, and I don't know, aluminum's not really a great market.
It's a fair question. I would say 90% of the time, which is pretty good, you're going to get the reaction that you expect based on earnings. It really is the most reliable thing you can count on in this market, is that when there's operating results of any kind, whether it's a mid-quarter update or the actual earnings report, the stock's going to do what you would expect it to do. Now, John mentioned we traded Gilead Sciences. They had the numbers just blew away expectations both times, and both times the stock just reacted with a dud. So it happens, but that's okay, because 90% of the time it goes the way we want it to go if we get the analysis right.
Which you usually do. So let's see. Rich, I'm starting to like Rich a lot here. Fun Day has taken out the low this week and now is above it. This irrational tankage will provide fantastic entry levels for equities by the end of October or early November. We are in complete agreement with you, sir. We are in complete agreement with you. John has a question or a note here on American Airlines. And give me just a second, John, and we'll take a quick look at that. So I just want to get my chart program up here. I'm just using freestockcharts.com. And give me 1 second, and I'll see if I can switch this over, and we'll take a look at this. And your screens are going to change. This will catch up to you folks in just a second. All right, there we are. So everybody, in a moment, as soon as the audio catches up, you should see a chart of American Airlines. And I want to back this out, and I'm going to give you John's question and point. But I want you to look at that right there. Yeah, I know the tip. Thank you. So John says, do you take any technical analysis into consideration? For example, AAL appears to be breaking down the support line today. However, your recommendation is long. A couple of points. Keep in mind, John, that our recommendation on AAL is not to trade until October 22nd. So we have some time. And as I just drew on the chart here, you're right, it's at its support, it's at a support line right now. So it's going to be a challenge in terms of American Airlines. But we think that earnings is actually going to be the conduit for this stock to take off again. No pun intended. If it breaks below roughly 31.50 there, you're looking at probably another support level between 28 and 30 in this range right here, maybe. I mean, that's not a lot of support, to be honest with you, right there. So yes, it could be breaking down, but in part, keep in mind that the airlines are also under extreme pressure because of the Ebola concerns, and the fear that basically we, the American public, are not going to get on airplanes. Let's keep in mind that the only way it got into this country was from West Africa. So, and I think there's one other case in Spain or France right now. This is not a worldwide epidemic. And as the government responds, as it is beginning to do, with tighter security controls, and as the market sees that airlines are not seeing a significant decline in passenger volume, I'm actually going to point you to Rich's point. You're going to get an unbelievable entry price on this stock. And you can see it's already bounced off its highs up here, up near 45. We'll count it right there 4 times. 1, 2, 3, 4, 5 times back in the summer months. And in our Millionaire Blueprint program, we've traded American Airlines 3 times this year for anywhere from 10 to 15% gains each time. And this is a stock that we actually are holding in our portfolio right now, but we have a longer view of the stock. But for the earnings purposes, you're going to wind up buying an option in the, even if it breaks down, you're looking at buying an option at maybe $30 right now for a company that's got to be valued up closer to the $40 mark. When they report earnings and they beat and the market reacts and responds, you're gonna see an 8 to 12% jump in the stock price over 1, maybe 2 days. But a fair point. And to answer your question a little more specifically, no, we don't do technical analysis, in part because we're using fundamentals to drive the selection of the stocks. Technicals won't necessarily advise us in any way other than the option price, the strike price, because we want to be at or in the money, and because we're looking at earnings to be the driving event for the stock to move. That's going to be predicated upon the company reporting earnings that are in the direction we expect them, and the market moving in our favor in terms of the direction. So little long response to you there, so apologies on that one. Fred asks, but great question, John, and thank you for asking. Fred says, does the 500 per trade allow for more contracts for lower priced options? It would, yes, sir. We'll give examples of that as we do the capital management function inside of our Monday report. First one coming out next Monday. So we'll go back to the screen for Gerald, who just asked for the deadline date again. So hang on just a second, Gerald. And this should come right back up for you there. There we go. So yes, again, 11:59 p.m. will be the deadline, Sunday, October 12th. We're actually another 30 people joined here tonight, so we're down to about 65, 70 people max to take in the program, but I'll let everybody know how we're doing as we go through the weekend. Henry asks, do you have a preferred brokerage firm for trading options? Henry, we are broker neutral. You generally want to find the lowest cost broker with the best execution and customer service. To find that information, I recommend Barron's online guide. You can Google search that one. I think Interactive Brokers was actually their number one choice. That's IB. I think they were their number one choice for options trading this year. It may have been for both stock and options trading, but Barron's online trading or online brokerage guide. You can just do that Google search, and Barron's does that every year. They do a very thorough analysis on the different brokers out there. Generally speaking, try to find a broker that's going to give you an option price that's not $10 to execute, because remember, you're going to have commissions in and out. So, $5 or less, please, if you can, on those options where possible. So that looks like that gets us down to the end of the Q&A. Jamie, I know we went a lot longer than we expected to tonight, but really excellent questions for everybody. So I want to thank everyone for their time. And I think I'll leave everything up here for a couple of minutes after we sign off. Jamie, any last thoughts before we exit?
No, I think we covered a lot of great stuff. You got 3 great trades. I'm excited for the season. We're going to have 6 weeks where I think we're going to find some big gain hunting and reel in some big fish. So thanks for everybody for coming, and hope you all join the program.
Awesome. Well, we look forward to seeing those of you who are in. If you didn't join, but you're, don't worry, you'll have an opportunity tomorrow and into the weekend. Again, you'll get an email as soon as this webinar wraps up, the replay, so you can go back and watch any part of the presentation you would like, and then we'll keep everyone informed as we get closer to the deadline, so to make sure that you get your last chance to get in if you haven't gotten in tonight. But don't wait. Anyway, for Jamie Delugus, Traders Reserve's earnings player, my name is John Hutchinson. I want to thank all of you for your phenomenal questions tonight and your participation and all of your time. We hope that we've made it worth it for you, and we will try to follow up with those of you who don't join us on those 3 trades that we've given you here, so that you can see how those work out and potentially join us next January. I hope everyone has a great night, and we'll see all of you again soon. Those of you who have joined, you will hear from us over the weekend and again on Monday at noon with your first Earnings Player Hot List report. Have a great night, everyone.